Today in InvestTalk, we discuss the financial risk of natural disasters for the average American. Then we discuss the breakout in small caps today. We also answer questions about Rio Tinto, HIMS, energy stocks, and more. And at the end, I discuss the Social Security COLA adjustment for 2025.
This is InvestTalk, independent thinking, shared success.
Now, my focus point concerns this topic about the financial impact of natural disasters. And this is a very interesting topic because we are in the midst of, we just had a natural disaster in Florida. And so there are some statistics around how impactful these storms, these events are to the average American. Now, severe weather hit the wallets of record 19% of Americans last year. That's up from 13% in 2022, from 13 to 19. Now, if you measure the impact of the severe weather, 2% said the impact was substantial. So, right, it's 19 sounds high, but only 2% said the impact was substantial. 5% said the impact was moderate. 12% said the impact was slight. Okay. Now, those living in the South were more likely to be financially impacted by severe weather. You would imagine that because the more impactful events are hurricanes, which we'll get to in a minute. Now, what impact did it have on people financially? Well, credit scores for individuals with poor credit prior to the disaster dropped another 29 points on average 4 years after a medium-sized disaster. So it didn't have to be something gigantic, just medium-sized, and it can have a major impact, especially on those in the lower end of the income spectrum. Now, the percentage of people with debt in collections rose by 25% 4 years after that medium-sized disaster as well. And the average debt in collections increased by over $2,000. So what it shows is that people that are already in a precarious financial situation can push them kind of over the edge to becoming financially distressed. Okay, so those that are not very financially well off, they're the ones that are hit the hardest. Okay, and have the most difficulty long term from the fallout from extreme weather. Now, property damage is the most cited form of financial fallout, as you would imagine. 4% said extreme weather caused income loss or work disruption. 9% said they faced property damage, and 2% needed to evacuate their homes temporarily. 1% reported long-term displacement from their homes. Only 1% said that, these disasters meant I can't go back, okay? Homeowners insurance is obviously the first line of defense, so you want to make sure that is up to snuff. And a lot of people are moving. 13% are considering moving because of these natural disaster events. 13% of Americans in 2023 look to move due to the threat of natural disasters. That's up 1% from 2022. 18% made some sort of home improvement to reduce the risk overall. That's up from 14% in 2022. And 5% upgraded their insurance policy. That's if obviously they can get insurance. So obviously doing things like reinforcing roofs, elevated foundations that can give you discounts in your property insurance and mitigate the impact of these disasters. Now, what type of disasters have become most frequent, and what are the most expensive? Basically, tropical cyclones are the costliest type of natural disaster. This includes hurricanes, resulting in nearly $700 billion in costs since 2014. And they only make up 13% of all billion-dollar weather events. And what this shows you is that these are the ones that have the most widespread impact. Okay, 54% of total costs since 2014 in property damage came from tropical cyclones and hurricanes. Okay, even though they're only 13% of these major weather events. Severe storms, they make up 22% of the total cost when they account for 62% of total events. Okay, so they can be damaging, but usually the damages are relatively minimal. The next is actually wildfires. Only 5% of total events are wildfires, but 8% of property damage. Then you have drought next, flooding is after that, then winter storms would be would be next, and that would be 4% of total costs. So, the hurricanes are the biggest the biggest threat here. Hurricane Katrina cost $200 billion. Hurricane Harvey, $159 billion. Hurricane Ian, $119 billion. Those are the top three over the past 24 years or so. And the states that are most impacted, you would think Florida. It's not. It's actually Texas. They had the most billion-dollar natural disasters from 2013 to 2023. Then it's Florida, Louisiana, California, and North Carolina. Those round out the top 5 states. The ones that had the least: Hawaii, Virginia, Alaska, Maine, and New Hampshire. So those are the states that, if you're looking to move out of the risky states, those are the places that you would have limited risk of natural disaster striking your financial situation. Now let's take a quick look at the market today as we close the week. It was a decidedly positive day overall. And really, it was the small caps that did the best. That small caps were absolutely crushing today. Small cap growth up 1.8%. Small cap value up 1.6%. The large caps still did okay. The value set actually led up 1.25%, whereas large cap growth is only up 0.75%. The big movers on the day were Tesla. Tesla was down 8.8%. We had the big robo-taxi day and robot day, or whatever you want to call that thing. Obviously, the market wasn't really buying the hype. Elon's typically good at hype. Is he losing his touch? His marketing touch? I don't know. But certainly the market didn't really like what they were seeing there. So I don't think I think that was dragging the market down overall. If you're talking about large cap growth, that was the big driver to the downside. NVIDIA was roughly flat, so that didn't really power anything to the upside. Uber had the best day of kind of the bigger, well-known tech names, up about 11%. But Bank of America, that was up 5%. I believe that was on earnings. You had U.S. Producer Price Index that did accelerate a bit year over year to 2.81 from 2.65%. But that's the core. And then, but month over month, it did decelerate to only up 0.16% month over month. So that was pretty good. On the inflation front, things remain relatively sound, especially, and everyone kind of knew that in September. Oil prices were down, so the producer price index is likely to feel some pressure to the downside, and that's what you saw. Now, since the beginning of October, though, things have moved upward, and that could change the look of the inflation data for this month.
I was calling in regards to ticker symbol RIO, Rio Tinto. I was wondering what you guys thought about entering Rio Tinto, or exiting, I'm sorry. I actually own 100 shares of it and was wondering, should I buy more? So just wanted to know what you guys thought about it. Thank you, and keep up the good work.
All right, looking at Rio Tinto, RIO is the symbol. And this is a diversified miner, but it mainly mines iron ore, okay? And so it does have exposure to copper, aluminum, diamonds, gold, industrial minerals, etc. But mainly this is a company that exports iron ore. And it recently went up from about $60 back in early September, all the way up to $72. Now it's pulled back to $67, but it's been in this wide trading range for a while. And I think the main reason here is China. Their main customer is China, and being able to export iron ore for the production of steel to be used in mainly Chinese real estate. And so that is obviously suffering, and their profits are suffering along with it. Profits hit a record high of $13.26 in 2021. But earnings this year are supposed to be $7 and also $7 next year. Now, you might look at it and say it's a $67 stock. It's roughly a 10 multiple. And that sounds cheap, P multiple. But, I always say you pay up for the great companies that have consistent businesses, and you pay less for those that are what we call price takers, those that don't have an economic moat. And that's what I would say with Rio Tinto. It doesn't really have an economic advantage, and therefore it's just a price taker, and that's why prices keep going up and down. They're buying a lithium company as well, which I'm not a huge fan of. Love lithium as an investment. So I frankly, I just think there are better opportunities out there. I like that you're in the commodity space. I just, the relative strength here of only 32. There are so many other material names that are in a strong uptrend that I would much rather reallocate this capital towards something better. So yes, I would sell it and move on. Thanks for the call. Now let's go and take a live call. And this one is from Chris in Atlanta. Oh, what was that? There we go. Yeah, Chris from Atlanta. And he is listening live I believe on streaming, correct?
Yes, sir.
Okay, great. And you are asking about energy diversification.
Yes, sir.
Okay.
Yeah, so I mean, I have a tiny portfolio. I'm trying to learn how to invest, listening to you guys. And Exxon is my main energy position. And I was going to diversify around that. I talked to you a few weeks ago. I had Oventive. It was underperforming, and I think you suggested it wasn't the best option. But if you were to diversify, to add a little bit to a position like that, would you look for pipelines? Would you look for smaller E&Ps? Like, what sectors would you look for to add diversification?
That's a great question. Let's talk first about Exxon and understand that in and of itself gives you a bit more diversification than your average oil company. Why is that? Because Exxon has a lot of different operations, right? They have a lot of exposure to oil, obviously, but they bought XTO Energy decade plus ago, and that was a big natural gas play, so they have exposure there. They also have downstream assets, oil refineries, obviously gas stations, things like that. And so, they're in and of itself, they're pretty well diversified. Now, what they don't have a lot of is the pipeline side, and those tend to be the most consistent businesses within the energy space. Are those companies that transport the oil or gas from one point to another? Because once you have that infrastructure in place, it becomes it's so much more expensive to move those in any other way, rail, trucking, whatever, right? Pipelines are quick, they're easy, and so those pipeline companies can extract a pretty nice hefty profit and toll from the oil companies to move their product from one place to another. So if I'm going to buy one other type of name here, it's absolutely going to be some sort of pipeline company.
Awesome, man. That's what I was thinking. I wanted to kind of make sure I was thinking the right way. I appreciate that.
Cool. Great. Well, thanks for the call, Chris. And thank you for listening and tuning in. Now, I hope you've been telling your friends that the InvestTalk podcast is available in video form over on our YouTube channel. You can check out me and my screen and the data that I'm looking at. You might even check out my dog in the background. He hangs out sometimes. So if you ever want to head over there, you can do that. And we get questions submitted via the comment section on that YouTube channel. And let's tackle one now. Jim Leahy says, what are your thoughts on TFII? TFII. Now, this is in the, what space is this in? I gotta pull this. Transportation. There we go. And it's a Canadian company, provides transportation, truckload, and logistics services. And this has been kind of chopping sideways for the last 6 months or so. But overall, it's in a broader uptrend. And I generally like the longer term chart. It's up and to the right. Okay. Now it came public in 2011 and really it was in a huge uptrend during COVID and has continued that. Why? Because earnings went from $3.22 in 2018 all the way up to $8.02 last year. Now earnings are expected to come back down to $6.62 this year from $6.18 in 2023. But go back up to $8.63 next year. So yes, earnings are taking a step back, but it looks like they should accelerate into next year. So I like that. Their balance sheet is very good. Only about $1 billion in net debt on $11 billion, $12 billion market cap here. And enterprise value even around 10, not a bad ratio there. Not a huge dividend, about 1%, but certainly some room to raise that dividend with that payout ratio only 20%. What are they doing with their strong cash flow? They have been buying back shares lately, so I like that. And their free cash flow is $627 million, and it looks pretty steady from here on a $12 billion market cap. Yeah, it's about a 5% free cash flow yield. I like that. So I'm seeing a lot that I like here. Good business. It's a not exciting business, but it's a very profitable business. So I'm going to give TFII a thumbs up. Now let's go talk to Art in Menlo Park asking about HIMS. And Art is listening live on AM 1220 in California's Silicon Valley area. Art, what do you like about HIMS?
How you doing, Justin? Before I ask you about HIMS, can I ask you a quick question on the 30-day rule?
Sure.
Does that apply to your 401k as well?
Yeah, so it's just if you have gained exposure to that exact, you're talking about the wash rule, correct?
Yes.
Yeah, so you can't just go buy it in your tax deferred account, right? But are you talking about selling it in your 401k, or are you saying you would buy it in your 401k?
Buy it back, actually.
Yeah, exactly. So it would the wash rule would apply for if you went and bought it in another type of account.
Oh, okay.
Yeah.
As far as HIMS go, I just think that it might be disruptive down the road, but I didn't want to pay the price that it's at right now. I'm just trying to get a better entry point as far as HIMS goes.
Well, I think if it's going to succeed and hit its expected earnings targets, which next year is supposed to be 74 cents per share. It's at $18.69 per share today. And it lost money last year, so it's make 32 cents this year. So it's emerging into profitability. And a big part of that, I believe, is the fact that you can now get GLP-1 drugs through that platform. And certainly that's a big driver here. And so, I think you're putting a big bet that these GLP-1 drugs will remain in style for a long period of time, because if suddenly these are not appropriate for the average person, which frankly I don't think they are for most people, but if that fad goes away, I think a big driver of HIM's profits will go away as well. Now, from a technical perspective, this is in an uptrend. It's making a series of higher highs and higher lows, and it just made a low back in September and is moving up nicely from here. Hit a low around 13 and change. Now we're at 18 and change, and so it's in a strong uptrend. I think from a shorter term perspective, you're probably not going to get much better of an entry point, to be honest with you. If this rolls over and goes back below the September lows, all of a sudden, the structural positive momentum that this has is broken, and you wouldn't want to touch it anyway. So,
right.
If you want to bet on the upside that they will hit their earnings targets, that the GLP-1 craze will stay in place for maybe a number of years at least, then I think this is a time you just buy it and ride that train. You have an out, and you have good risk management here. But beyond that, it's really a very speculative name, and as I said, the driver is something that is typically a fad, and we'll see how durable these GLP-1 drugs are. But certainly, that's what's driving the stock over the last year or so.
All right, thanks a lot, Justin.
No problem. Thanks for the call, Art.
I'm calling to ask a question about Silvercrest Asset Management, ticker SAMG. I was just curious on your opinion of it, and if you think I should add more or get out of it. And I was also just curious about your guys' opinion on the asset management space, just in general. Thank you for the question. Have a good day.
All right, looking at Silvercrest Asset Management. This is about a $240 million market cap, so relatively small. And it's a wealth management firm. They do what we do. Right. And it's focused on providing financial advisory and related family office services to ultra high net worth individuals and institutional investors. So they advise clients on equities, fixed income, hedge funds, private equity, real estate, commodities, etc. And it's a good business. You're talking about return on equity. Actually, no. I'm saying it's good business because I'm in it. But it's their profitability is actually not that good. 6.7% is the return on equity. That's not that great. They do have a good balance sheet, so I like that. $20 million in free cash flow, so the free cash flow yield is strong, but that return on equity is pretty poor. I wonder why. It shouldn't be that bad. Its long-term average is closer to 10, 11%. So it's definitely under earning compared to its history. So that there could be some issues there. Pays a dividend, but I don't think a dividend is going to rise anytime soon because their payout ratio is 85%. If you look at the chart, if I zoom out on a weekly, it's pretty good, but not amazing. It's in a relative uptrend since the COVID lows, but relative strength is only 49. So it's very middling in its performance here. It doesn't get me excited. It's a good business. It's a consistent business. It has good cash flow. It has a good balance sheet, but those profitability metrics are pretty weak, and the relative performance is pretty poor as well. So I just think there's better uses of your capital. Thanks for the call. Now on Fridays, we generally make time to fit in a quick rundown of some key benchmarks. The 2-year yield, 3.945%. That's up from last week's 3.9%. But, it's still way up from where we were a few years ago when it was hovering around 0.5%. Okay. And so this pullback in yields is likely maybe done in the short term. You're seeing the 2-year rally. A lot of that's to do with economic data that came in a bit stronger, and therefore the pricing in of the Fed dovishness became a little more hawkish. So that's why the 2-year yield rose a bit. You saw the 10-year yield rise as well, 3.97% at the close last week. Now we're at 4.0%. Basically 8% this week. So pretty big move on the 10-year to the upside. And gold prices at $26.59 an ounce. That's a little bit up from $26.49 at the close last week, and way up from where we were just 48 weeks ago, less than a year. We got $1,935 per ounce. Silver at $31.55, down a bit on the week from $32.19. But still way up from $22.80 just 34 weeks ago. Oil prices edged up a bit to $75.69 on the WTI from $75.32 last week. And you're starting to see a bit of an uptrend, mainly because of the geopolitical concerns in the Middle East. National average for gas, $3.20, a 2-cent increase from last week, but way down from 119 weeks ago, about 2 years ago, $4.25. So you continue to see gasoline prices at pretty nice levels compared to where they were just a couple of years ago. Here in California, gas is averaging $4.66 flat week on week, down from $5.87 about 2 years ago. By comparison, Missouri, $2.85 per gallon today. Now, let's touch a bit on, let's go with, what are we going to go to? Let's talk about the leadership in markets, okay? And through the first half of the year, the markets were really driven by tech and AI stocks. But since the start of the third quarter, you have a new set of sectors that are starting to outperform. You're talking about utilities, materials, and industrials. They're really taking the baton of the market and broadening out the returns. And that is overall bullish. It's positive. That's why it's funny. Everyone says, "Oh, markets are new highs. I'm waiting," or I don't want to put money in because it's expensive. And there are pockets of the market that are expensive, but you have to look at the totality of the situation. Is that earnings continue to rise and the breadth continues to widen out. And what you're seeing, and the reason why it's widening out, is because the growth rate for the Mag 7 is actually decelerating from a pretty high level, but it's decelerating. And the rest of the market is actually accelerating, okay? So if you're talking about earnings growth for the fourth quarter of last year, that's when the Mag 7 growth peaked out at nearly 60% year over year. But now in the third quarter, this last quarter that ended, earnings growth is only supposed to be about 18%, okay? Whereas the second quarter, the other 493 companies in the S&P, that was in the high single digits year over year. So yes, the Mag 7 is growing faster still, but it's also in many instances priced for that, and that's priced in. And so you have to consider when you get the rest of the market accelerating and the Mag 7 decelerating, you're getting other sectors kind of taking the lead here. Now, for the third quarter overall, S&P 500 earnings are supposed to be up for the fifth straight quarter to 4% year over year. Okay. Now, if you look at early reports, there is some weakness out of some of the consumer names, FedEx, Nike, but overall, companies in the S&P 500 are still doing well. Now, they're trading at a premium about 21.4 times. That is higher than the 10-year average of 18.3. So I think if you were to see, to argue against the continued market rally, that would be the case. It would be technicals, the fundamentals that the multiples are elevated. But as we've said many, many times before, the number one lesson that you have to unlearn, right? A lot of people just look at PE and they think that that's an indicator of where the market's headed or where a particular stock is headed over the next 12 months. There's an extremely low correlation with how cheap a company is trading at today from a PE perspective and its forward-looking one-year return. Now, if you go out 3, 5, 10 years, that can have some predictive power. But momentum matters more, okay? And the momentum in most of the market, especially now, as industrials and materials, financials continue to power to new highs. A lot of these stocks have very strong momentum. It doesn't matter that the overall P ratio is higher, at least for the next quarter, 2 quarters, even 4 quarters. It has a very low correlation. Why is that? Is because you continue to have liquidity. When liquidity is abundant and money is flowing into the system, it needs somewhere to go. And equities are typically a good place for that. Hedge against inflation. And people are comfortable. They're happy. They're okay. They've seen the returns. They're powering money back into the market. Now, when things go south, liquidity tightens up. Then what happens is people start to focus on the fundamentals again. And they say, which one should I sell? Well, this one has an elevated P ratio. And then those are the ones that pull back the most when liquidity kind of ebbs, are those that are expensive. So when the market's in an uptrend, frankly, fundamentals don't matter that much. Momentum matters more, right? Growth of earnings certainly matters. But overall, you don't look at PE and say, I'm going to buy the cheapest PE companies and that's what's going to go up. Not how this works, okay? So there is a bit of a gap there between valuations and where the market average has been, but that's not indicative of a major market pullback. What would be indicative is actually liquidity ebbing, and there's really no evidence of that. Central banks around the world are loosening policy, and you have dollar liquidity around the world growing at the highest levels since 2021. And so it's very understandable why the market breadth is widening out. Now I'm going to play another listener question, but first I want to briefly mention the newest KPP Premium newsletter, which will be distributed tomorrow. And this week in the KPP Insights section, we discuss an update on the current market environment. In the stock section, we mention a digital payment company and a management and holding company. And in the portfolio management section, we touch on private placement investments. If you're interested in learning more, visit investtalk.com to subscribe. Now, the newsletter will come to your inbox every Saturday. Now, here comes another caller question from 888-99-CHART.
Hello there, Dylan here from Houston, Texas. I've been listening a little over a year and love the show. I'm 25 years old and have a question about retirement funds. I am currently matching my employer's contribution of 3% through a simple IRA. I am then maxing out a personal Roth IRA through Fidelity. Through this, I'm buying the Vanguard S&P 500, ticker VOO, and Vanguard's Value ETF, ticker VTV, and switching those up every other month. Is this good enough, or should I be contributing more through another account? Secondly, I'm getting married in December of this year. Any recommendations on combining our retirement funds or keeping them separate? Thanks in advance. Bye.
Well, congratulations on getting married. And the first thing is you never can combine retirement funds. Everybody's retirement account, whether it's a 401k, an IRA, a Roth IRA, whatever that is, it's an individual, not together, not a joint account. Okay, you can open a joint account, but that would be a taxable account in both of your names. And so a lot of couples do that, especially if they don't have a trust or anything like that. So that's number one. Now, when it comes to your strategy, that's a simple strategy, rebalancing kind of between value and kind of a growth portfolio, which is what the S&P is at this moment. Now it's all equities. It's aggressive. I think broadening that out to mid and small caps would probably be my number one recommendation. And then from there, it's a matter of how much more work do you want to do. Obviously, using ETFs, that's very simple, but it's hard to be targeted, right, with that particular strategy. But at least broaden that out to mid and small caps as well. Now, when it comes to saving, should you save more? Well, it sounds like you're maxing out your workplace retirement option, the simple IRA, as well as your Roth, and that's great. Should you save more in, say, a taxable account? Maybe, but that would be more of a financial planning view. Is what are your broader goals? What's your income? How much could you save, etc. I always say if you can save more, save more. And there's nothing wrong with doing that in a taxable account. There are tax advantages to owning a taxable account, right? The gains come in long-term capital gains and dividends that are treated better than normal income. So I would save more if you can into a taxable account and probably set up jointly with your wife, it sounds like, or future wife. There we go. Now here's another question submitted via the InvestTalk YouTube channel. Dominiquez says, "Hi, Matt from England, looking at Axis Capital. The symbol is AXS. I hold a small position. Love to hear your take on it." And Axis is a mid-cap name, about $6.8 billion market cap, and it's a Bermuda company, and they offer property and casualty reinsurance and insurance products worldwide. And you would think with all the natural disasters that they would not be doing well. Well, they've been able to raise their premiums and earnings was to go from $5.65 last year to $10.78 this year and $11.32 next year. So pretty solid name, if you ask me. So I like the insurance business. It's boring. I know. A lot of people out there, boring. It's insurance. Well, it's a great business, really. Return equity about 12.5%. They have a good balance sheet, good cash flow, about $1.5 billion free cash flow on a $3 billion enterprise value. I love that. What are they doing with all of that cash? Well, they are now buying back shares again. So I would buy more on dips, to be honest with you. Now, I will say the MACD is starting to weaken a little bit, so you may be ready for a bit more of a pullback, maybe into the mid-70s. Now they're at 80 or so. And so that would be my only critique here with that. I think it's overbought near term, but I would be buying more on dips. Thanks for the call. Now, lastly, let's touch on Social Security COLA adjustments. And this number is always based on the third quarter inflation figure from what is called the CPIW. And this is the Consumer Price Index for urban wage earners and clerical workers. Now, I think it's kind of a dumb one to use because how much are their costs linked to those of retirees? Probably not that much. But nonetheless, that's how they measure it. U.S. retirees will receive a 2.5% increase in their Social Security check starting in January. On average, that's $50 more per month. Okay, $50 more. Now, that rate was for 2024. For this year, it was 3.2. So you're getting a bit of a step down in that COLA adjustment, but still an increase, okay? But that's the smallest annual raise since 2020 when that was only 1.3%. So it's the smallest raise since the pandemic, okay? Now, If you are getting supplemental Social Security income benefits, you will also get that 2.5% raise. This is for the elderly and people with disabilities. Now, 72.5 million people will benefit from this increase. This is so important. And that's another reason why, the economy remains relatively sound, because over the past few years, these 70 plus million Social Security beneficiaries are getting pretty hefty raises in their payouts, and their typical costs are not going up quite as much. That's what the studies show. So they're getting an outsized return here on a real basis. Now, in January, the maximum amount of earnings subject to the Social Security tax is set to rise to $176,100 from $168,600. So if you don't get a high enough raise, you're going to get more of your salary. Like, say if you make more than $176,000, you are going to get more of your salary taken for Social Security withholdings. So that's also set in this adjustment. So just be aware of that. That's a kind of also taxes the average person that's making a decent amount of money a bit more. I always think that's our tax code definitely hurts the high income earner that's not making a ton of money, right? Millions and millions of dollars. And this is a good example of that. If you have a good job, you're a doctor, maybe you make 300, 400, 500,000, right? You're doing fairly well, but your tax burden is so large. And this is another example of that tax burden that will increase a little bit unless your income goes up accordingly. So pretty interesting little piece of data there for all of you that are looking at Social Security, taking Social Security, as well as earning above $176,000 a year. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and calculate your risk number. Just go to investtalk.com and click on the portfolio review button. This is free and a confidential service as well. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.